Hello, everyone, and welcome back to another episode of Capital and Context. Subscriber numbers have gone through the roof this week. Must be me forcing people in my review meetings to actively share their screen and hit that subscribe button. So thank you to my clients that have doubled our viewer numbers, which is great. Here as ever with Sam Hallett.
Good morning.
Morning, Sam. So we were coin tossing between topics this week. Rate hikes and rate discussions and general interest rates is what's one. But we therefore will do a thrilling episode next week on industry acronyms. We thought it'd be interesting to throw them back and forth to each other. So but yeah, Sam wanted a week's practice on those to not get caught out on camera. So we'll do that one next week. But yeah, so this week's topic is rate hikes. Ultimately, what does it mean for clients' portfolios? So as ever, lots of these things are sort of central Bank of England, Fed, dictated. We're probably going to keep a bit of a UK focus to this. We haven't spoke too much, I don't think, about the Bank of England and the rate setting committee in other episodes. So it would be good to understand the mechanics of how that works and why Sam felt it was a good topic to talk about. So over to you, Sam. Where are we now, and what is the rate picture out there?
So thanks for the intro. I think actually if I take a step further back and go, what were we looking at the turn of the year? So the futures market was very much pricing in 2 rate cuts for 2026. In actual fact, there was some who felt that was a little bit pessimistic, and there might have even been more. We ended up through March, which obviously we don't need to talk about the exact news stories behind that because it's quite obvious. At one point, gilts were pricing in 4 rate hikes this year. That's now come back down to somewhere between 1 and 2. To be fair, I think there's a balanced picture. There's a bank
hikes or cuts
of rises.
Okay.
I think it's an interesting dynamic at the moment. So I don't think it's an exact facsimile to 2022. 2022 was largely caused by, well, don't get me wrong, there's very much a supply side shock, obviously, with the shipping element. But but demand, as we know, people were spending lots of money in 2022, which was, helping push that inflation up. Whereas this time around, it's more of a very much solely a supply shock. People don't have the discretionary buying power that they did coming into 2022. So how strongly do they need to go on interest rates? It's probably a little bit softer than before. So it could be that the market might be slightly overpricing things in. There's actually a Bank of England meeting coming up on the 30th of April. 90% of economists, and I tend to agree with them, are saying it'll be a hold, nothing will change. But as is always, the thing that's more interesting from our perspective isn't actually that, it's what goes on in the press conferences immediately afterwards to find out where the individual people, because there's 9 people on the committee that sets interest rates in the UK, and it's to work out how are they compared to their normal biases. Some people want to cut rates, through the floor all the time, and vice versa. So it's to work out where's their position compared to their natural stance.
Yeah. Our acronyms episode is next week, but these aren't technically acronyms. But for the viewers, because I'm sure you're going to use the terms, could you explain clearly the hawkish and dovish tones that do come out in those minutes to help people understand what those mean and what the best way to remember them are?
Yeah, the best ways to remember them. So to be fair, when I think of a hawk, so hawk means someone who wants to be rate rises, very much, quite predatory, you might want to say, on the markets. So I don't know. Actually, have you got a different way that you think about it? obviously, but
No,
that
I think
leader
a
made.
hawk, yeah, strong taking off.
Yeah,
sort of
exactly. Whereas, a dove
Dove,
is a
softer.
softer,
Yeah.
weaker bird. So they tend to want softer interest rates.
Yeah.
Yeah, never thought of it like that before.
Yeah. Dove gets used on on washing products and things like that, which is sort of the soft soft cycle essentially. So yeah, that's the way I remember it anyway.
I never look at
And a hawk, taking off, and
I never look at my laundry
soaring.
detergent the same way again.
Yeah. But no, that I'm sure those words will come up. So a dove is someone expecting rates to go down, and a hawk is someone expecting rates to go upwards. And they're very commonly just thrown about in use. So I thought it was a good point to touch on that. I think just to recap on what you just started off on there. What has been the time period for the change between a view of rates cutting? Like, is it should we be looking back 18 months to when it was almost everyone convinced that rates were being cut, because we were up as high as 5.5 or so? What's been the time before we go forward? Can we just go back to what that rough sort of scale between maybe where everyone was on the cut side to where we felt it was a bit of a mixed bag, to now your statements around people having 4 rises? That's a massive swing from people having 3 cuts.
So
what's the timeline on that?
It was very, very rapid.
Okay.
Talking 1-2 weeks. You're literally going from the 28th of Feb, i.e. the day before.
So we're still on like a pre-Iran schedule here.
Yeah.
Okay, so it's not like going back a year, it's gradually migrated.
No, it was
been a very
literally a shock kind of effect. As I said, they've come back from 4 rate rises now, back down to about just over 1. Obviously, you can't have 1 and a bit rate rises.
Is this UK or
UK
specifically? Because America's still raised, right? Or
No, they held.
Okay.
To be fair, don't get me wrong, we're going a little bit off piece, but America is quite a bit more insulated from what's the fallout of
Fine,
this.
we'll keep it UK specific. Are there any sort of big names that are put in these quotes you're sort of putting around 1 cut or 2 cuts? What are some of the big investment banks and things saying to sort of validate where they are?
Yeah, sure. So kind of like, not an investment bank, but an economics consultancy, Oxford Economics. They're now, to be fair, one thing I should say, there's quite a diverged range of opinions at the moment. Don't get me wrong, I think some of that depends on when exactly they have put out their notes. Obviously, this has been quite a rapidly changing subject matter lately. For example, Bank of America are saying 2 hikes in June and July. I'd like to point out no one's really saying April, but BOE are saying June, July, and 2 or quite aggressive rate cutting structure in 2027. JPM are kind of around about the like where market pricing is, saying 1 hike in June, and that's about it. But Goldman's, for example, saying 0 cuts. But one thing that they say to be wary of is there's like a once and done risk. So that being like, we raise, but that might not be enough, oddly. So there's a divergence of views of that, but as you would expect, there's also divergence as well within the Monetary Policy Committee.
Okay. And the economics of raising, and this sort of, I guess, leads on to bonds and particularly government bonds and how they're priced off various things. But again, for the listeners, in raising rates, what are the Bank of England trying to achieve?
They're basically, by raising rates, you, through various, there's various mechanics of how it feeds through, but slow down demand within the economy, in essence, because it's more, say, like if you were to be buying a car on finance, by raising rates, obviously you make the interest rate that you have to pay, to finance the vehicle more expensive, makes it less affordable, which means that you're less likely to buy it. which means that, in theory, that manufacturers would need to temper their prices in order to sustain demand. So that's the idea of the mechanics behind it. As said, this is different to 2022 in the sense of there isn't a huge amount of disposable income massively floating around anymore, which means that they don't need to be anywhere near as aggressive as they were in 2022 to rein this back in.
And in terms of bonds, what's the likely effect on bond prices?
So
and bond yields, which obviously are related.
Yeah. So obviously we say this, but just to reiterate, bond yields move inverse typically. There's a few outliers, but move inverse to pricing. So a rise in bond yields, if you already hold a bond, you end up with a degree of capital loss. So what we would be expecting is the most sensitive bonds to this would be your sovereign bonds, mostly around the 5-year mark. Longer dated bonds are more, the pricing around them is more dictated by the fiscal prudence of the sovereign, whereas those shorter dated are more about monetary policy. So that's the sweet spot probably at the moment, is around about 5 years. Corporate bonds are less sensitive on this, so long as they don't end up being stressed by obviously their income's coming down through lack of demand, etc. That's the caveat. So that's one area that we're putting a lot of focus on at the moment on our on our research, is where do you want to be on the credit stack at the moment? Because if that demand does come off a little bit too much, then you don't want to be exposed to, say, more high yield, more risky corporate bonds. You want to be perhaps a little bit more on the sovereigns. But there's very myriad ways to interpret it at the moment, and that's an awful lot of what our job is.
Yeah, and what's already happened, obviously the fact that we're talking about it on a podcast is too late to kind of say, I'm going to go and sell my government bonds this morning because they're going to go down in price because rates are going to go up. I assume part of this move is already priced into the bond market.
Well, in part, the reason why we can't say the things that we're going to do because we've already done them. I'm glad to say. So, when this all kicked off 6 weeks ago now, crikey, that's doesn't seem that long ago. Immediately, your head thinks, okay, supply end shock, inflation rising. Where do you not want to be? So, that's why we moved down the credit stack just to be a little bit more safe, on the expectation that credit spreads are basically how much you get paid for the additional risk of a company who's lending off of you compared to the sovereign debt, which is deemed to be, in inverted commas, risk-free. Probably less likely to be over the years ahead. And how so basically that it was very cheap, that was likely to blow out. It might be one of those areas that I'm still a bit tentative on for the year ahead. I think it's going to be more of a year of where do you want to be in terms of years and longevity. We moved quite a bit from Euro government there because they're going to be, in terms of developed markets, are very exposed on this. And also that they have, they opened, depends on your viewpoint, they spent quite a lot of money in 2022 to support, people through higher gas and fuel prices. So they're going to end up doing that again. We've already heard things passing through for, in terms of fuel duty cuts and so on and so forth in a lot of markets. That isn't good for sovereign debt because ultimately it just means that you're throwing more onto the bondholders. So we moved that instead into short end inflation-linked bonds.
Okay.
So what that does is that when inflation rises, is that basically the coupon that you receive for holding that it increases. So that can be very powerful if inflation expectations increase, and we were quick on that. However, I think we're now in an environment where you need to start forward looking to what happens when we go from a ceasefire to a settlement. And that's where a lot of our planning has been in the last 48 to 72 hours, is kind of going, okay, the pressure is now on from various components in the world. We need to look at what's moving forward. And I think I think you're going to end up with 3 phases moving through the year.
Okay. And so back to scenarios of rate rises. So let's just say there's one rate rise, probably won't massively affect either bond or equity markets because
it's already priced
movement's already priced in. Yeah. So probably at what point do you think, potential scenarios of 3 rate rises for whatever reason they choose to go down that route, or the reverse, that we actually don't get a rate rise and we see a rate cut before the end of the summer, let's say, what effect would you see those scenarios having on equities?
So that is a really valid point, actually, because people often forget that this is probably one for next week, but on a discounted cash flow modeling scenario of how to value equities, one of the inputs into that is basically the risk-free rate. So in essence, your sovereign rate. So an increase in sovereign debt yields, so rate rises, means that actually the discounted cash flow value of a business decreases. So at the moment, as you said, we're priced in 1, so not big of a deal. I think if we go down, I think 2027 could be really interesting, by the way. So if we end up with rate cuts come through faster, then that's going to be a real power move for real tailwind for specifically on, say, the FTSE 250 in the small cap space. They will really rally fantastic off of that.
Yep. Okay. And just because they're a sort of subject that we're looking at this morning in investment meetings, money market funds, which have been a useful tool for us. What's been going on in that space, and will this result in rates of those going back up, and how quickly would we expect to see that as a sort of more advisor asset allocation tool?
Yeah, so people quote erroneously money market tools as being nil duration, so not sensitive at all to interest rate changes, which is just not true. They are very short duration, but not nil. So we had last month, the returns were, they had a little bit of a capital loss. Don't get me wrong, you still got a positive total return because you had the coupon coming through. But you were looking at an annualized rate for just 1 month of around about 2.5%, somewhere around about that percent. And the reason for that is because the rate expectations going up, so they sold down a small amount in capital value. Not just that, the credit spread opened up a little bit, which is an additional component there. However, I would expect this month and next month to be returning more in the region of 4% annualized through. And I think, if I'm honest, I don't necessarily think it's at a point where it warrants a huge change in clients' portfolios and where in the weighting they're going to. I think there's still the carry now on sterling investment grade debt is now 6%. And this is there's quite a lot of AA, there's a lot of AA rated corporate debt within the sterling market. I think that's a better place to be at the moment. I just think that if you're willing to hold that through to maturity, there are some products out there that do specific year-end dated bonds. I think that's possibly a better place to sit at the moment than money markets.
Yeah. Okay. And yeah, just I think switching slightly off topic, but we'll end with it. We were talking yesterday that it's a year since the bottom of the Trump tariff wars.
I've got an update for you since the update, actually.
Oh, go on then. Before I wrongly accused you of wrong numbers from my review meeting.
Yeah, you did. Yeah, I love this. The numbers were so positive. Mark thought I was lying. No, so actually, since the update that went overnight, now means that actually our 1 year P5 return numbers is just nudged over 30% for the year. 1 year, 30% return. And I think all of the P portfolios. I think one of the P portfolios is measured on 3.4% of outperformance versus benchmarks on the year. So it's genuinely a really, really good year that we're really happy with. Bear in mind that actually it's not just been a straight year. Obviously we had last month, which I'm glad to say on this year we're positive on, which I think is important, but also in that in April last year as well, obviously that was and we worked well through that. So a lot of our outperformance has actually come from those wobbly times, so I'm really quite happy with how we performed over the last year on those portfolios.
No, that's an extreme. I don't. That's.
Certainly don't expect that all the time.
It's just a 1 year where you catch the bottom of that sharp sell off, which again, the last 3 sell offs have all been very, very sharp, which again just reflects the last 10-15 years of sell offs, that there's been more tools and more sophistication, or that one wasn't even, that was, again, the start of the sort of geopolitical, psychological warfare, really, where, again, we did well out of that because there was a lot of panic, sell-off, and we did, I remember lots of long meetings around, is he actually bluffing here? And then 2 days later, there was articles about it, like our best poker game in the world, and we I think made a lot on the portfolios in that window by not being the people selling and panicking and just doing what everyone thought was running for the hills. So we don't really want years of that. We want years of 30% returns, but we also don't, because that's right at the edge of the volatility of what we'd even want our portfolio 5 doing, really, right?
Oh, yeah, but I wouldn't say that's typical. Do you have a point, sorry, just on here, which reflects very well about what you're talking about in terms of selling off at the bad points? Unfortunately, it isn't directly on here, but that's a shame. It was a good point, which is basically, if you took away the 10 best trading days, your returns over 20 years comes down 20%. And the vast majority of those best trading days are in bear markets. So it's actually, when things have already sold off, it's a case of, okay, what's the outlook moving forward? Not looking in the rearview mirror.
No, agreed.
I think that's what I mean. Where we're at right now is working out, okay, what is the next play? Actually, the thing that we haven't spoken about, which, to be fair, could almost deserve its own episode in itself, is emerging market debt. I think because obviously it's been an exposed area lately, I think it could be really fun for the rest of 2026.
Okay. Look forward to seeing those trades.
That's one for the Christmas review.
Yeah, no worries. Great. We were back next week with acronyms, which we thought was a bit of a sort of change away from the sort of slightly heavier sort of economic sort of topics that we've been focusing on. But that's what's been dominating the world and markets. Thanks as ever, Sam, for taking the time away from the research and things. Hopefully another useful episode. Very much focused on the Bank of England and rates. And we'll be back same time next week. Thank you.
Bye-bye.